Hello, my friends. This is Joe Padovich, P-A-D-O-V-I-C-H. I'm at my office again today, making phone calls today, as we always do on Wednesdays. We make our phone calls, we do some videos, we talk to you guys out here. And what we're looking at today is the Fed lower interest rates a 0.25%. Now, 0.25% really isn't a lot, but it is something, okay? And here's you can see my name right there. Padovich, P-A-D-O-V-I-C-H, that's me. Just so you can see the spelling of my name, P-A-D-O-V-I-C-H, that's Joe. So the Fed lowered the interest rate, 0.25%, as I just said. So what does that mean to you? What does that mean here? Now let's look at this interest rate here. Look what they're doing in 1985. And now I'm just showing you this. I'm not bringing up a chart from today. This is even an old chart. It could be, I'm not sure how old this thing is. But if you look at it, what does this tell you here? How interest rates really can affect a home. How interest rates can really affect your purchasing power of a home. And even your whole lifestyle. Okay? Now, let's look at 85. Interest rates were 12%. Even before that, in the early 80s, it was 20+%. In the late 70s, it was really high. And what he says, we'll do a recording, a video on the high interest rates and how they fluctuated down during the Reagan terms and why they're high. I'm not an economist, but I know a little bit about this subject, so we'll talk about this for about 15 minutes or so. So let's look at the 1985, and I'm not sure what year this is. I'm just using this for example. But look how high interest rates was. Look how much money you could purchase. You have the ability to buy a house. You see what I'm saying? Now, obviously, houses in 1985 were nowhere near the value of what they are now. It's been 40+ years. But look at the homes. Look at the interest rates in 2000, 8.29%. Look at the difference of what you can or can't buy. Look at the difference, what's available out there. You're looking at $100,000+ difference in a 3.89% mortgage versus a 12% mortgage. So there's a significant movement here in the property and what you can finance, what you have, or what you have the ability to buy. Now, also related to interest rates, look at the interest rate. You're buying your home based on your interest rate, because the interest rate is so high or so low that you can afford only so much. So that interest rate you have is going to put you in that city, not the fact of the price of the home. Of course, the price of the home is related to the interest rate. But if you have an interest rate 12% versus 3% or 5%, I think interest rate now is like 5%, 4.75%. We'll have to double check on that. But here's the thing. When you look at interest rates and you look at the value of what you're paying, look, the payments are going to be the same. You know, the payments are going to be the same, or a few cents off. That's not going to make a difference there. But it's the home you're purchasing, what's going to make the difference. When you purchase a home, your interest rate is the determining factor in most cases. Okay? So when you're getting a credit card, if it's like low or high, it's going to tell you what you can or can't buy on your credit card. That's important. So when you look at a home to purchase a home, and your first decision is now how much money I can afford, is what my interest rate is going to be based on the value and based on what I can afford to buy, that right there is going to really affect you, because you're looking at a home, say for example, you buy a $600,000 home, and the interest rate's pretty high. And so when you pay the $600,000 off, you're not paying $600,000. You're paying like another $300,000 above that for interest. You're paying all that money and above for interest. Okay? So when you purchase a home, you're going to look at the interest rate. That's what a smart person does. Knowledgeable person does. They look at the price, but they look at the interest rate. What is my interest rate? First thing the bank is going to do is they're going to say, hey, Bill, or Joe, whatever, Billy, or Sam, whatever. They say, I'm going to get you qualified for a home. Here's your interest rate. So you're taking that interest rate out there to buy a home. The price of the home is irrelevant. Okay? It's your buying with the interest rate. You notice here, if you look at this here, Everything is about what? Interest rates and about the mortgage payment. The interest rates are what they're going to be, but your payment, monthly payment, is the same. But look at what you can afford. Okay? Look what you can afford. So you're purchasing based on your interest rate. Your interest rate is going to detect everything about your purchase and what you're going to buy and how you're going to buy it. So the thing about this is yeah, Joe, hi, my name is Bob. I'm qualified for a $500,000 home, condo, whatever it is, and my interest rate is 4.5%. Oh, okay. We'll look for that. We'll look that up. We'll check that out. We'll check everything out for you. Oh, okay, you can afford here. You can afford this. You can afford these condos. You can afford this townhome. You can afford this. Here's this. Okay, so your interest rate is what's driving your property value to you and your mortgage payment. And it also is going to drive of what you can afford and what you want to pay for in the future. Say, for example, you're 35 years old. You're starting out, you have a new baby, wife, kids, a dog, and you have a two-bedroom house, and you're 35. Okay? Your wife has a room, you have an office, and you have a bed, and you have a child's room. Okay? And you're starting out. And you're like, okay, I want this house. And you get this house, it's really nice. So, but down the future, 10, 15, 20 years in the future, you want to move. Because the other house grows. So, but what you're doing is you're gaining value and equity, of course. But you're still owing money on the interest. So the important thing about this is make sure you have a good credit score. Absolutely. Make sure that when you go to a lender, they properly give you the proper interest rate. And make sure that you have no debt, car payments, credit card debt, and all that stuff. So you can get the 3.9. No, it's not 3.89%. That's probably 2000. I forgot what year it was, like 2021, 22, around there, maybe a little bit around there. So when you look at your purchase of your house, you got to make sure everything's paid off, and you have to make sure you have good credit, low credit card debt, low debt anywhere, and you can get a good interest rate. So in other words, 10, 15 years down the line, you're not just paying off. Right now, you pay off all interest in your property. And you take interest first, then you're paying off your property. But you want to pay off your property now and then building the value up. So you got to watch your interest rate. When you get a lender, watch your interest rate. Make sure that you go to the right lender. They know what they're doing. Credit card are not a good investment. They're bad, no matter what they say out there. They run commercial that you're going to get 3% back. Capital One, all these companies do this. You're going to get 3%, you're going to get 3% back. But remember, you're spending 95%, 97%. And on top of that, you're paying the interest rate on top of the credit card. Think when you purchase something, think when you use something, and think when you're looking for your home, because that's going to help you. Okay? So when you're out there looking to purchase your home, you're going to say, yeah, that guy Joe on his channel said, yeah, get rid of the credit card debt. Get rid of this. Now, I know there's millions and hundreds of thousands of people out there that say the same thing I am, but the fact of the matter is, that's correct. You're not out here to save 3% and pay 97% plus interest on a credit card. You're here to save money. You're here to lower your debt, and you're here to get into a nice house, which I can help you do. Okay, I'm at 949-439-0383, because the most important thing about it is your home is your life. Okay? But you can't let your life or your home affect you mentally, emotionally, anyway, because when you buy a home and you have the proper interest rates and the proper what you need for your home, pool, whatever you want, you have that home, you have that happiness in your life. But the most important thing is, besides buying a home with the interest rates and the credit card, is another thing I want to talk to you about here. I brought this up a little bit ago, but I want to talk about it again. The Fed cut the interest rate 0.25%. Okay. Now, I'm not a math guy. I can get my calculator out and do it real quick. But the important thing about it is that means when the Fed cut the rate 0.25%, that's going to make an effect on stuff. but not really significantly. But it's going to affect the price. So if you're out looking for a home and you already have a pre-approval letter, get that redone. Check on the interest rate, because if you lower 1/4%, that's going to save you, I would say, about $100 to $150 a month, if not more. I could be wrong on that, but you have to do the more. Just go to Mortgage Calculator or mortgagerate.com, and it'll tell you the actual interest rates. And there's other bank rate and all those other ones will give you the information on the interest rates and what they cost and what you could save. Now, here's another thing I want to talk to you about home purchases. You have to realize the interest rate you're paying or being cut is in the numbers. It's actually in your mortgage document. But one thing I want you to look into and really think about is unnecessary costs related to a home purchase. Now, I'm not going to sit there and say, oh yeah, buy this, don't buy that, because that's your decision. My decision is just to give you the information. So here's the information that I want to give you. First things first, like I said, think smart, be proactive, and think, okay? Because if you like something, here's an example. Summer's about over. And you say, I want to live on the beach. I want to buy a beachfront property. Okay, great. I'll show you a beachfront property. We can sell you one, but here's the thing. Do you want to own a property on a beachfront property to own it? You want to own a beachfront property to rent it? Or you want to own a beachfront property to lease it? Or you want to own a beachfront property to visit it? If you're on the beach, okay, and you're on the ocean, whatever it may be, if you're on that ocean and you're looking out and you see the beautiful water and you see the beautiful sunset and you see all the beautiful everything, the fish, the coolness of the air, the night air, the beach at night, everything's cool and quiet. Everything's cool and quiet, and it's pristine and it's beautiful. But then you signed a 20-year lease. And every single night for 20 years, you're going to see that same beach. You're going to see the same water. You're going to see the same sunset. After a while, it gets a little tiring. You know, like a TV show. You watch a TV, whatever TV show you watch, okay? But if you watch it every single day, now it's okay to have a binge watch occasion. I'm not talking about that. But if you watch the same TV show every single day, you'll get tired of it. You'll change the channel. But once you buy a house on the beach, you can't change the channel. You're there at the beach, or at the river, or in the hills, or wherever you might be, you're seeing that same light every day. So my thing is about when you buy a home and you want that beachfront property, think, look, analyze, reanalyze, and think again. Oh yeah, I want that beachfront property, but I don't want to own it. I'll rent it out for the month. Let the other person buy it and rent it out. I'll do that. I don't want to live here every day, but okay. Or what about I have to have a gated community now, okay? Or I got to live this way, or I got to live on Wilshire. You go to Wilshire Boulevard in LA, West LA by UCLA. For those who don't live in California, Wilshire Boulevard, go 453 Wilshire Boulevard. That's a pretty big intersection, and everybody kind of knows it. Just look it up on Google. But if you see all those high-rises up there along Wilshire Boulevard and Wilshire Corridor, those things are very expensive, and they're beautiful. I've been them a few times years ago, but they're beautiful. They look really nice. But you want that opulence. You want the guard at the gate. You want the parking in the building. You want all this other stuff. You want this, like I just said, the security guard. You want all this. And you're paying for this stuff. Plus, you're paying for the interest rates. Because remember what I'm talking about. You're not only paying for the interest rates. I'm going to go a little bit over here. If you're not paying for the interest rates, you're paying for these amenities. Okay? The gated communities, Corte de Casa, all these gated communities, Hidden Hills, all these gated. You're paying for the gated community. You're paying for this stuff. If you're just a regular guy like me, you want to have a nice house. Do you want to live in a gated community? Maybe. That's your decision. Okay? But what you're looking at also is not only the interest rate, but you're looking at what you're buying with the interest rates. Okay? You want to move into a condominium that has high condominium fees, association fees, plus you got to look at if they're doing any kind of building or any kind of master plan work. You got to look at that stuff. You got to look at, I mean, you're going to pay that above the interest rate. So it's not only the interest rates that you got to look at. You have to look at what you're buying with it, and if fits your lifestyle. Okay? Now, if you're going to go on the beach, and you're like 26, and you're going to go on the beach and run the beach, and you got a wife and one kid, we'll live on the beach. Okay, that's beautiful. But you have to know what you want in the future. Say, like when you get a job and they interview, what do you see yourself in 5 years? People say, oh, that's an odd question. I don't know. Not here. I don't know how people are going to think. But a house is different because you're paying for a house. A job, you can just go. Okay? You could just move from one place to the other at jobs and stuff, unless you're a technical person, you're doing some stuff and it's different, like you're a scientist and you're like really an invested person into a business. That's different. I'm talking about being an employee. But when you're buying a home and somebody says to you, hey, Bill, or Becky, or whoever, what do you see yourself in 5 years in this house? I don't know, I just want to buy a house. What do you see yourself in 5 years? Okay? That's what you can look at. What do you see yourself in 5 years? Do you see yourself moving? Do you see yourself staying there? Do you see yourself upgrading? Do you see yourself more married? Do you see family? What do you see in your future in your home tied to the interest rates? Okay? Now, interest rates will go up or down. You can refinance and do stuff. But that's important. What you're doing is important. Okay? Now, what about living in a snow county where there's snow or hurricanes or things like that? You have to look at this stuff, how property values are, how the crime rates are, how the schools are. Another thing is also important about when you buy a house and you look at interest rates, okay, do you want an older house that needs a little bit of work? Okay, which will cost you anywhere between $10,000 and $50,000 in repairs. Do you want a brand new property, totally brand new community? Buy a brand new home and pick your lot up. And pick your lot. Okay? Here's the important thing to look at this. When you purchase a property, we talk about the interest rates. We talk about thinking, being knowing what you're going. You also have to know what kind of property you want. Are you looking at a property that's, like I just said, needs a little bit of work, but are you looking for one that's brand new? You're looking for a brand new built house, which is great. It's beautiful, has all this stuff, but here's what it has. It has costs. Okay? One of the costs it's going to have is Melrose. Now, what can Melrose be? Melrose can be a couple hundred, inexpensive. Now, I'm going to get the calculator. It should take me like about, real quickly. Give me about a half a second here. I'll just do a real, okay. Okay, Melrose tax, okay? It's a special assessment in the community, okay? Now, so I'm not going to do the calculations, but here's the thing. Melrose is a tax, because what is Melrose based upon? Melrose is based upon not the property itself, but the community built, okay? When they build a community, what's the first thing they need to do? Okay? What's the most important thing they need to do when they build a community? They need to do these two important things. Actually, more than that, but two important things. One is get the water to the community, okay? And two is electricity. And then three is gas and all that other stuff. But the most important thing is get the what? Get the water to the community. So they got to build new sewer systems. They got to build new streets. Everything's got to be curved up. Trees, the whole community's got to be built. Now, if you go to like lawyers and people that deal with new communities, they got to call it what they look it up, like all these new home buyers, the whole communities, they have what they call renderings. And you can pick what you want at your property and they'll build and they'll build the property for you. So the thing about this is you have to look at the cost of building the property which is called renderings. And then renderings is going to show you, and they're going to, oh, here's what the interest rate's going to be here on your on your loan, of course. But you also add up the cost of the what? The Melrose. That's what you buy new. And here's another thing you're looking at that's important you have to think about is mortgage insurance. You're going to pay a percentage for mortgage insurance. Okay, now how do you avoid mortgage insurance? You have to have equity and all this other stuff, but FHA loan, you can have mortgage insurance. If you get an FHA loan at 3.5%, you're going to pay mortgage insurance. Okay, now mortgage insurance is percentage. Let's look this up. I take me right here. You know what? Mortgage insurance. Mortgage insurance rates. Okay. FHA loan, 1.75%. Of your payment, okay? And I'm looking at these numbers real quick. Like I said, I'm not a math guy, but I'm a knowledge guy. But I know a lot about this stuff. So I just looked it up. It took me a second. So here's the thing. Mortgage interest is going to cost you money, maybe $100 a month, maybe $50 to $200 a month between that. Melrose is going to cost you money. Then they also have, like, these new communities will have special assessments if you live in a community, a homeowners association. Here's another thing we have to touch base on. Homeowners association, we talked about this a few minutes ago, but not really in depth. We'll talk about that. So you look at your interest rate. You're looking at Melrose. You're looking at about mortgage insurance. You're looking about what else you're looking at, and you're looking about your homeowners association dues. And don't forget that. You have your property taxes due. Don't forget the other stuff. You have your other stuff that's city taxes and all stuff. Then on top of that, you have everything else. You have to pay your house, your lifestyle, your car, your house, and all the other stuff. So all this stuff means what? Pay attention, think, analyze, rationalize, and reanalyze, and pay attention. So when you're buying a property, say, Joe, I want to live in Irvine. I want to live in that new community, Irvine, off Culver. I'm not sure it was off Culver that was years ago. Off Culver Boulevard in Irvine, off Culver Boulevard and Irvine Avenue in the city of Irvine. I want to go out there and I want to buy a house there. It's brand new. It's a new community. I mean, you know, where there used to be the El Toro Marine Base years ago, like Great Lakes. So I said, okay, Bill, Bob, whatever your name is. I said, okay, well, the interest rate there, you have an interest rate that's really good, which is like 4.25%. You could afford to buy a $2 million home, okay? You're going to have, now I'm not sure if you will or not, but you have Melrose, which is going to be about $75 a month or whatever number it's going to be. You're going to have mortgage insurance, which is going to be another $110 a month. You're going to have a special assessment for the community about another $45 a month for the security guard, the gate guard, and the staff that work in the community. And then you're going to have another $180 a month for homeowners insurance. And then on top of that, you have to pay your stuff. So you look at that. So you're going to look at that and you're going to say to yourself, wow, so instead of buying a $2 million home, I'm going to buy a $1,500,000 home or thereabout in order to reduce the reduction of my costs within my home, within my lifestyle, because you're not only buying the house for that amount, but you're paying the interest rate. You're paying the homeowner association. You're paying the Melrose. You're paying the property taxes, okay? And you're paying other costs involved, okay? Don't forget your mortgage insurance, which is, so everything's going from here out to here, okay? And don't forget special, so think about this, when you buy a home, the interest rate's great here, what we're talking about. We're showing you interest rates, what it can get you. But interest rate is not only the determining factor when you buy a property. Here's what I recommend you do when you're looking for a property. I got a couple minutes up here to go. One is, check the value of the property, what it's worth, what it could be worth, what the potential is. Okay? Now, there's a community in Whittier that I'm working on. I've spent time there working. but there's a school there that's closed down. The school's been closed down about 4 to 5 years. Now, a home just sold there recently in that community. But the thing about this is, when a school within the community is abandoned, that affects property values. So when you look at what's affecting the city, is the schools going to close down? Or is there special assessment? Or what's happening here within this community? How's the interest rates going here? How is this affecting this? So when you look at everything and you make your decision and you look at the cost, I'm at 949-439-0383. I'm the only Patovich on the DRE. Just look me up. And like I said, here's my spelling of my name there. And so the important thing is about what you got to think about, not only what is important. You have to say to yourself, I want to live in that house over there. And I'm willing to take whatever it takes to get in the house here. I want this house. Okay? I like this area. I like this stuff. It's a beautiful place, and I like this area, and I want to be here. Here's an important thing about this is, when you have the discussion with the real estate agent, like with me in the bank, and you look at everything, I'm going to help you buy that house. I'm not going to question, are you sure you want this house? You're going to say, Joe, hey, Joe, I want to meet you. I want this house here in Whittier. I'm not going to say, are you sure you want the house? Because you made that decision. My job is not to make sure that you want the house. My job is to make sure that I get it together for you and I do what I need to do so you can get the house, so you can purchase the home you want. I'm not going to say, hey, Bob, are you sure you want that house? Can you do better? I'm not going to ask you that. I'm going to make sure that it goes through the qualifications of passing everything, that goes through everything that needs to be gone through. And on top of that, it's not only the place you're going to want to live or want to be, it's going to be a place that you're happy with and you can afford. And I want to close with this. This is critically important. Buying real estate, selling real estate are two different things. Okay. I'm here as your fiduciary to help you sell a house to you, or help you purchase it. Either way, purchase or sell. Your job is to pick what you want within that. So when you go to the supermarket and you're shopping at Walmart or whatever store you're going to, you're going to be walking down the aisle and picking things up and get what you want, okay, throughout the store. Now, nobody's going to be there telling you to get that, get that, get that. Or they're going to put stuff out for you, or end cap sales, and putting things out for you to look at, for you to see, for you to like, oh yeah, I want that. But there's nobody telling you, oh yeah, Joe, why don't you get the peas? Why don't you get that instead? Why don't you get that instead of that? They're not doing that. Well, they're doing that, but somebody at the store will say, hey, I need help, and somebody will help you. That's me as your real estate agent. I'm here to help you pick your groceries out of Walmart or whatever supermarket you may have, and my job, I'm the checker helping you out, getting through the process. And we're going to make sure everything's good. Hey, I appreciate you coming in, watching my video. Remember, quickly, interest rates are very critically important when you buy, live, and what you have. But also, the additional costs that we talked about numerous times. Think, rethink, reanalyze, pick what you want. I'm here to assist you. 949-439-0383. I thank you for coming in. Have a great day. Take care, and thank you so much. And thank you so much for stopping by, and I thank you so much. Have a good day. Bye.